All right. So we have a long chapter 14, and this carries substantial part of your exams because it has about 10 units. So we have the audit report and the meaning of a true and fair view. Then we have the modified auditor's report based on ISA 700, 701, and 720. Then we have audit reporting and KAMA. We have the modified auditor's report, ISA 705, 706. Unit 5, we have the auditor's responsibility relating to other information, ISA 720. We also have the impact of the auditor's report of, the impact on the auditor's report of opening balances and comparatives, ISA 510 and 710. We also have the impact of going concern on the auditor's report, ISA 570. And communicating with those charged with governance, ISA 260. We have to communicate. Sorry, you're not muted. AP, you're not muted. All right. So we have unit 9 and 10, which is speaking to communicating deficiencies in internal control, ISA 265, and unit 10, specialized areas. So let's see where we can cover quickly. Then we close for the evening. We're already fast going to 10 p.m. So let's look at the audit report and the meaning of a true and fair view. So we don't want to rush because this carries substantially part of the AAA exams. Sometimes it may come in question 1 or question 2, and it comes materially with heavy marks, 15 marks, sometimes 20 marks question. So let's take it bit by bit, unit by unit. Wherever we stop, maybe by 10:05, 10 at most, we should rest for the night. Okay, so let's see where we can move fast a bit and see how to stop for this evening. So looking at the auditor's report and the meaning of a true and fair view, we've had that statement or that phrase concurrently, frequently throughout our AAA class. So the auditor's report speaks to direct communication to owners. Simple. The auditor's report. What is an audit report? It's the output, the outcome of an audit, and it's communicating the audit's result or report to the owners. Very simple. The shareholders asked for an audit to be done depending on the nature of the audit. If it is statutory, by law, it's required. So what is the end result? Is communication of what the outcome of that report is all about. So in brief, historically, the audit report speaks to contributing to the expectation gap between the public and what it expects from the agents of a company. So the public expects more than the auditor's statutory role. It's supposed to guarantee, for example, fraud prevention, 100% testing. So there is the expectation of the public in regards to audit reports. And the expectation is that there should be fraud prevention and also 100% testing, which practically may not be 100% practicable in real audit work. So the responses to this expectation gap is that to strengthen the corporate governance framework of a company, auditors' disclaimers, not in Nigeria currently, but more informative auditors report based on ISA 700 series revision, ISA 701, speak to disclaimers. And what are those disclaimers saying? The disclaimers are saying that it's not possible to have 100% testing, and that is why assurance cannot be absolute. You cannot, as an auditor, say assurance is absolute 100% that financial statements are free of material misstatements. No. You cannot say 100% because there's no word as 100% audit, but you can say substantially nothing has come to our attention, and that's why we speak to the expectation gap. So the public believes there should be fraud prevention 100% and 100% testing, but in actual practice it's not possible, and that's why we're responding that there should be a disclaimer that okay, this is what the auditors have covered. We are not giving absolute assurance, but we are giving reasonable and substantial assurance, and based on these ISAs that we have done our work and nothing has come to our attention. And that's why sometimes you have audit failures, and that's because auditors are not supermen. Some things may pass or slip their fingers, and it's possible to have audit issues after audit reporting. So we have electronic reporting. Auditors should verify electronic and paper versions are identical. So now that the audits of most companies have gone digital, most of the time you deal with soft copies, you do virtual interviews, current way of auditing is now very, very sophisticated and with some degree of accuracy. So we have electronic reporting, and this culminates in the true and fair view that has always been during paper time, predominant paper time. Now it's now going digital, predominantly digital. And everything that speaks to that speaks to the true and fairness of the presentation of financial statements. So in equivalent terms, not rigidly defined, but it relies on the auditor's judgment. So the true and fair view is based on sufficient and reliable evidence obtained during the work to come up with this assertion that the financial statements provide a true and fair view. So in equivalent terms, not rigidly defined, it relies on the auditor's judgment to come up with this conclusion. And what does it imply? It implies that we are in compliance with laws and accounting standards. So has the IFRS been complied with? So from revenue recognition in the performance statement, which is the income statement, is revenue complying with IFRS 15? So the costs and the expenses, whatever models or whatever area of the component of the financial statements is presented, does it reflect the accurate or the appropriate standard? So this is very important for compliance, and it's also part of the true and fairness view process or area of reporting the financial statements. Also, to some degree of accuracy of figures and estimates is part of what it implies. Do these figures and estimates provide a substantial trueness and fairness or fair view of the financial statements? And also you look at meaningful presentation and disclosure in the financial statements. This is very important. Also, avoidance of bias by the auditors, distortion or manipulation should also be an implication of the true and fair view of the financial statement. And there shouldn't be any concealment of material information that will affect decision making of the shareholders or stakeholders of the company. This is key. So that's a brief to the auditor's report, and this is what it speaks to fairness and the true and fair view of the financial statements and what reporting is all about. So in sum, the audit report is about communicating to shareholders or those that asked you for an audit report what the audit report is all about and the outcome and results of what is done, whether positive or negative, and whether it culminates in true and fairness of the financial statements. Okay, so that's unit 1 of the reporting module, which is a long module, and it's, like we said, carries a chunk of your exam questions. So please pay attention to it. So let's look at the unmodified auditor's report. If you don't have any question, please feel free to interject as usual. If you have any questions, please interject and get clarity. Okay, so we have the unmodified auditor's report, ISA 700, 701, and 720. Please take note. The unmodified report means opinion not changed, no extra paragraph after the opinion, given when financial statements are materially compliant with reporting framework. So what does this mean? When you hear unmodified, so if modified, you have edited or altered something. But unaltered means the financial statements, based on our presentation of the trueness and fairness or fair view of the financial statements, nothing has come to our attention that shows that there are material misstatements, and the financial statements complies with the international financial reporting standards based on our jurisdiction. But if it's in the US, it complies with the general acceptable accounting principles. So a modified opinion it means not changed. So when you hear unmodified, that should inform you speaking to something that has not changed, unmodified. Then when you hear modified, something has changed, something has been materially misstated. So those are the clear differences and how to spot or speak to them under exam condition. Unmodified, unchanged. Modified, something has changed. Very simple terms. So you use it to craft or navigate around how to speak to this under exam condition. So the unmodified report provides high assurance of no material misstatements found. So the auditors have done their job. They have sufficient, reliable evidence based on their testings, based on the work they've carried out, that there are no material misstatements that are found or that has come to their attention during the course of the work. And in reaching that opinion, the auditor evaluates sufficient evidence. So don't forget, in crafting out your phrase or your answers, make sure key phrases are in these things. That's what is marked. And if you say some things, no matter how the sentence is constructed or the paragraph, you are marked correct. So you cannot, based on a question asking you, please explain unmodified report, and you said there are no changes or no material misstatements. On what basis? So you continue by saying that there is sufficient, reliable evidence to arrive at that opinion. That provides credence. That provides credence to what you have said. You can't just say there are no what do they call it? There are no extra paragraphs after the opinion or any issues of material misstatement. That is not complete. But if you now come up with the assurance that you have sufficient evidence to back what you are saying, that gives you the full mark for that question you've just explained. So the auditor evaluates sufficient evidence and the materiality of misstatements, and in compliance with the applicable financial reporting framework, which includes the true and fair view for fair presentation frameworks. So this shows that you've explained modified, unmodified report very, very importantly. So no extra paragraph. Extra paragraphs come when there are issues. You issued an opinion, but you have material misstatements which you want to modify. That's when you now have extra paragraph to modify that opinion. Very important. So what are the basic elements of an unmodified report based on ISA 700? There's a format. So in preparing their opinion, they have a title, the independent auditor's report. So the title speaks to the independent auditor. They have maybe their logo, the firm, and is addressed to whoever asks them to do the job, who they are working for, which is either the shareholders or the board of the company. And the third page is the opinion. So you have the first page, the independent auditor's report. The second page, the person, the recipients of the report, who are the shareholders or the board. And you have the opinion, and the opinion is either qualified or unqualified, modified or unmodified. And speaking to unmodified is an opinion. And the basis for the opinion, the international standards of auditing used for the job, the independence of the auditors, the sufficient and appropriate evidence they have that made them come to that conclusion of this opinion, which is very important. Then the going concern, which is material uncertainty. Can the organization continue in the near future? So this is very, very important in bringing or performing, in writing the going concern aspect of the report. Then key audit matters, if applicable. So where key audit matters that needs attention or that management or the stakeholders, the board need to be aware of, will come under this session. And other information that are relevant and applicable would come also under the key audit matters. Number 8 is responsibilities for the financial statements. Who is responsible for preparation? Is it management? And predominantly it's management that is responsible and not the auditors. After that, we have the auditor's responsibility for the audit, and their responsibility is to speak to the trueness and fairness, and if the applicable financial reporting framework has been applied and complied with materially. Number 10, other reporting responsibilities, if applicable, of the auditors could be stated. Then the engagement partner's name, who is signing the financial statements. For listed companies, if applicable, and for public interest companies, and the name of the engagement partner and his signature under, and the auditor's address. Of course, the title has the independent auditor's report, but the auditor's address has the head, the firm letterheaded, or the logo or the stamp, and his address, which is the firm's address also that he works for. So it's not the firm signing the financial statement, it's the engagement partner, the person that was engaged. The firm cannot sign the financial statement. The firm is a separate entity, but people work for that firm. So these people that sign financial statements are auditors, audit financial statements. So they have the address as the audit firm, and they make sure they provide their signature based on that appropriately. After that, they date the audit report not earlier than with sufficient evidence they've obtained that the statements they've signed we've done the work on the today's 28, we did it on 27, that was the last evidence we had, so we are signing on the 28th, for example. In ISA 701 is a standard speaking to key audit matters, and this is specific to listed companies or public interest companies. And where required, maybe voluntary audits for sole proprietorship, partnership firms, or small companies could apply when they ask for audits. But it's is mandatory for listed companies and public interest companies. So key audit matters include matters of most significance in the audit, selected from those communicated with governance. So what does that mean? Key audit matters could mean management during the audit to say, okay, you are doing statutory audit. Can you focus on this area? Focus on maybe revenue, focus on these costs. Please focus on these areas that are of concern, matters of concern to us. So they could be requested by management. It's not a modification, but the auditors consider risk and significant judgments and significant events. This is very important. So any event that would impact the decisions of management and key stakeholders should be given very utmost priority. So it's described in a separate section explaining why it was key and how it was addressed. So if, for example, management is concerned about a particular area of the company or the financial statements, they will speak to the auditors, and the auditors will address it. And in their report, they will state how they addressed it and how their conclusion has come to by whether the opinions are material or immaterial, and if they have this level of conduct, and they are providing assurance to management that nothing has come to their attention of any misstatement. So these are key audit matters and how they are treated based on ISA 701. Very important. Okay, so let's look at the next area, which is modified opinions. So we just looked at unmodified reports or opinions. So let's look at modified opinions based on ISA 705 and material going concern uncertainties, which is ISA 570. And they are inherently key audit matters, but are explained in their own section. They are not duplicated in key audit matters. So modified opinions are based on this request or based on what the auditors are doing on the financial statements. Where they find material misstatements, they could modify the opinion based on key issues they found. And the emphasis of matter based on ISA 706 is for fundamental matters not considered as key audit matters or issues to come under that area. So where management attention are supposed to be drawn to particular events in the financial statements, then under the modified opinions, auditors could draw their attention to that. And the emphasis is fundamental for key audit matters. Now, we have other matters in ISA 706, which are issues outside the financial statement. So they don't overlap the key audit matters. So other matters could be outside financial statements, not just the computation, the SCI, the SFP, and the cash flow statement. But there could be other, maybe value-added statements, statement of change, or notes to the account that they want to bring management's attention to. So the auditor's report prescribed by law or regulation must still contain core elements to refer to the international standards on audit. So audits under both ISAs and local standards, where before we were using statements of auditing, Nigerian local standards. I know we had the statement of accounting standards and the Nigerian audit, standards on auditing. Permitted, if no conflict leading to a different opinion on the emphasis of matter, the jurisdiction of local standards must be clear, and local standards prevail in case of conflict. So this is speaking to the fact that normally most companies are supposed to comply with international standards of auditing, but where there is a conflict, the local standard of that jurisdiction prevails over the international standards, and that's what this is saying. So normally some people argue that the ISAs should prevail over the local standard, but there's permission if there's conflict leading to a different opinion based on what the auditors have come by. The local standards should prevail based on the auditor's opinion in that local jurisdiction. Also, unaudited supplementary information other than ISA 720. Auditors read for material inconsistencies with audited statements or knowledge. Based on supplementary information provided, the auditors need to consistently ensure that the financial statements information and that of the either discursive aspect, there are areas where you have accounting policies, they should marry, they should be consistent, and there should not be inconsistencies or dichotomy. You can't be saying you use IFRS 15 to measure your revenue or provide revenue recognition, the revenue line of the business, and they are inconsistent. So whatever standards you are explaining should marry with the figures. That's what we are speaking to. And separate and other information section in the report stating the management's responsibility, what was read that is not audited, and the auditor's responsibility, and any identified material misstatements should be stated clearly in the discursive elements. So this is very, very important. Okay, we're almost 10 minutes gone now. We need to stop here on the second unit so that we can rest. Let's not rush this unit because I believe some of us have started sleeping by now. Yeah, we had a long day. So we'll stop in unit 3. We'll continue tomorrow to make sure we finish this reporting and delve into chapter 15. We have 2 more chapters before we start our intensive past question. We first look at our mock, then we'll now go back to our practice questions